Paul, how should someone out there pick an ETF?
So great question, Seth. There's a few things to look at. First off, 82% of mutual funds do not beat the market on a year-to-year basis.
And a mutual fund is different
than an ETF. A mutual fund tends to be an actively managed fund. Great question.
Someone like a financial advisor or something might put you in.
Well, somebody will have, yes, correct. And they're going to get fees on that. They're going to charge it. Then the management company, the mutual fund company is going to charge fees. They have payroll, all these things. The idea behind an ETF, a low-cost index ETF, is that it matches the market. So 82% of mutual funds don't beat the market. And over a 10-year period, it's less than 1 or 2%. This will match the market pretty much to the T. The fees are 0.09 to 0.2%. When a mutual fund can be upwards of 1 or 2% a year, plus the management fee from your money manager. So you're upwards of another 1% there. Now, I will get into that shortly in our retirement calculator, show you how much that really does cost you versus an ETF. But the goal with an ETF is follow the market. This is what the market does. This is what the market's value does over time, hypothetically. This is what the market's pricing is doing. The whole idea of dollar cost averaging, which is buying this ETF every single month, no matter what happens. Don't look at the news, nothing. You're buying over, you're buying under. You're buying over, you're buying under. And over time, this is what you're paying.
In essence, I never have to quite worry if I'm buying high or low.
You never, ever have to think about it. You just put the money in every single month. Sound boring? Can be, but guess what? What do you want to be bigger? Your ego or your bank account? I learned that from Tim, from a lady named Danny Johnson. What's more important to you? The size of your ego, the size of your bank account? Do you want to be that person who's always actively managing your money and, I'm making moves? Or would you rather wake up and go, yeah, I'm rich as F? I know the way I am. I'd rather be rich as F, right? And for most people, you can't just sit in cash because you have a set on a time for retirement and you have the earlier you start, the better. And you don't know where the market's going to go. Is it going to go up, down, left, right? You have no idea. You have no clue. So the best thing to do is this. Now, the great news is if you want to get a little active, I recommend this. My recommendation always is to friends and family. And again, this is just a recommendation. I'm not telling you to actually do it, but this is what I like to do. VOO or SPY. These are low-cost ETFs that match the S&P. I always tell people put the majority of your money in these. That's what I would do if I was not an actively managed person who actively manages my accounts, okay? I have a different situation because I have 8 or 9 businesses upstairs. I have all these things going on. I don't need to be in the market. I can wait and be patient.
Well, we're talking 1,000 units of real estate, seas in the Caribbean, houses in the Caribbean. I mean, you have a lot of things going on, not like a normal viewer.
Correct. So what I want you to do, though, is learn from just like Warren Buffett. Warren Buffett always says, hey, if I didn't manage money, I'd be out putting my money in SPY. When I die, I'm telling my family, put your inheritance in SPY. Just match the market. But what you can do is these ETF companies like Spider, they make ETFs for sectors. So let's say a sector gets beaten up. Let's say COVID happened. Jets is an ETF for airline and transportation. It collapses. You say, wait a second. I don't want to evaluate every company here, but I think this industry as a whole has been beaten up too much. I'm going to buy Jets. That's one way to get in. I personally don't own gold, but I own gold miners through GDX and GDXJ. I believe in the gold mining business, and I believe that gold is going to go up in the future, so I invest in the companies. I don't want to make an evaluation of every individual company. I made a play on gold miners in general. This is the way to use ETFs to make a play specifically and make yourself feel like you're doing something a little bit better. But still, don't lose track of SPY and VOO. Do not lose track of that. Because at the end of the day, it matters big time.
Yeah, Paul, so you showed me this before, and these numbers are staggering.
It's unbelievable how much actively managed mutual funds hurt your retirement. How much a financial planner can hurt your retirement. Okay, so we have a tool here called the Retirement Calculator in our software. What this does, it takes your current age, takes your income, savings, blah, 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 and tells you how much money you'll have at retirement and upon death. Because most retirement calculators stop at retirement and say, look, you have plenty of money. I've literally shown people that will have $5 million in retirement and they'll be like, this is great. And I say, well, yeah, but based on your spending, you're going to go broke before you're 90. So what we do, let's say you're 30 years old. I don't know what the average age of our viewer is, but let's say it's 30 right now.
Pretty good.
And you retire at 65. Your current savings is $100,000 and you want to save $12,000 per year. But you also want to increase your savings by 3.5% per year because as time goes on, you're going to make more money. So you want to save more. So 3.5% per year. Now, over long periods of time, the S&P has done 9.9% a year. So let's assume 9.9 minus the 0.1% for SPY, you're going to make 9.8% per year. And during retirement, you take your money back a little bit more cautiously and you only make 5% a year.
Maybe you buy bonds, you take it out of high-risk stocks.
Well, yeah, whatever it is. You do more conservative things. You don't want the fluctuation. Question, what age do you expect to live to? I always tell people, go to 100. Listen, in the book Psychology of Money, assume the worst on that one because you're going to live a long time. The last thing you want to do is be 90, 95. You've lived and then you don't have enough money to pay for your life. And inflation, let's go 3.5%. And let's say you're currently making $75,000 per year. And you want to spend 100. You want to spend like you still make the same income at retirement. You hit the generate button, and guess what? Do you have enough for retirement? Yes. And here's the calculator. Now, at 9.8% a year, at the age of 65 when you retire, you will have $7.7 million. $7.7 million. Now, what does that change to if you do an actively managed mutual fund? So guys, remember, the actively managed mutual fund will automatically not beat the market. So you're down from 9.8, just call it to 9. And then the mutual fund company is going to charge you 1%. And then let's say your financial planner is a really nice person and says, I'm only going to charge you 0.5%. So you went from 9.8 down to 9.
Oh, that's rare, Paul.
Minus 1% for the mutual fund company, minus 0.5%. You're down to 7.5% return. Now, here's the key. Your financial planner is going to brag about something. You're going to hit generate. And your financial planner is going to say, look, you gave me $12,000 a year and I gave you back 4.4. What a genius I am.
Yep.
Remember the previous number was?
7.7.
7.7. Your financial planner costs you $3.3 million. And guess what? You had enough to retire? Not anymore. You got to almost double your savings now. You need to save more, around $9,800 per year more.
Just to hire this guy or gal?
That's exactly what it's costing you.
Come on.
Over a long period of time, it's costing you $9,800 a year. So I got to ask yourself, what's more important? To me, what's more important is I want to do less work. So I want to get in the SPY and VOO, just put it there and never think, never do anything, just keep down, and I will be richer because of it. And in this situation, if you listen to your financial planner, like, look, I give you $4.4 million. What a genius I am. Yep. You know what else? You're broke at the age of 86. You have no more money at 86. You're done. You're done. Where's your financial planner going to be at when you're 86?
Dead.
Probably dead or living off your commissions.
So there's two options, Paul. I go to a brokerage like Fidelity or Schwab. I sign up within 5 minutes. I start buying VOO or SPY for the rest of my life.
And you're rich as F.
Find some guy on Google that I hardly know. I know very little about him.
Or your friend's golf buddy who's a really nice, smart guy. He understands the markets. Spoiler alert, he doesn't.
And then entrust him with my life savings and hope it works out.
Yep. And guess what? It doesn't work. You end up with $3.3 million less, but in his eyes, you gave me $12,000 a year. I give you $4.4 million. Who would argue with that? I would. So guys, stop believing in that. Just buy low-cost market-based ETFs. Take control of your finances. Take control of your finances. It's not that difficult. Just go in there, buy month in, month out. Don't look at it, and you'll wake up years from now massively wealthy.
If this concept speaks to you, click this video about more investing strategies.